Good morning. It's Jeffrey Christian of CPM Group. It's about 10 minutes after 8 here in New York on Friday, the 5th of April. Gold prices have set 3 new records this week, and they continue to be high. As I speak, gold is trading around $2,318 for the June contract on COMEX, off a little bit from its high a couple days ago. Silver is a little bit below $27. It's around $26 or so. It has gotten over $27 in the last week or so. I want to talk about what are rational price expectations after such a sharp price rise. You know, the gold and silver markets are polluted with a lot of people who expect outrageously high prices. And as soon as the silver price rises $1, there are people on the internet saying, oh, this is the beginning of the end and the conspiracy is breaking down and silver is going to be $1,500 an ounce and gold is going to be $30,000 or $15,000 an ounce or $10,000. Totally outrageous and totally unsubstantiable expectations. And I want to talk a little bit about those times, but what happens after a gold price spike. And I'm going to focus on some of the periods where gold prices don't necessarily rise further after they've spiked. This is a chart of what's happened over the last 5 years in gold. You know, we saw the price start to rise sharply in the middle of 2019. It's been high by historical record levels since 2020, 2023. At the end of February, gold was $2,036. That was the low on the last trading day in February on what was then the April contract on COMEX. Over the course of March and the first 4 trading days of April, gold prices rose $289.30 from that low to the intraday high on April 4th. So you had a 14.2% increase in the cost of gold as well as the price of gold over the course of a month and a week. Very sharp increase, probably not sustainable on a long-term basis, at least at that rate of change. And we saw several records set. So let's look at historically what's happened. And again, you know, we always point out, yes, gold prices rise and they spike higher on an intraday basis, and then they come down. And we saw a spike when gold prices were freed from 1968 into like 1971. We saw another spike 73, 74. We saw another spike 79, 80. Another spike 1985, 87. You know, you see these spikes and then the price falls back. And then after 2000, you saw a much more dramatic spike because the price rose to higher levels. So you see these spikes and then you see the price pull back. Sometimes you see spikes and then there's a secondary spike. But a lot of times that's not the case because what goes up often comes down. So what are the rational future price expectations after a sharp increase? Sharp upward move in gold prices. We're going to talk about that, which we've seen over the last, I say 7 weeks here, but it's really more like 5 weeks. What do past sharp spikes tell us about what we might expect to come after the last, this current spike? And if you look at history, I've got 5 examples here. There are instances where the spike and the subsequent fall back in gold prices is followed by higher prices later. The post-spike price outcome seems to depend a lot on the economic environment, where we are in an economic cycle when the spike occurs. And I have a list here, but I'm going to go through them. This was the big one, 1979, 1980. And you can see the gold price actually rose over the course of 1979. It started 1979 below $300. I actually started covering the gold market in January of 1979, partly because the people I was working with No one else wanted to cover gold, silver, or platinum group metals, precious metals. They were dead in the minds of a lot of people who were involved in the metals markets, base metals, non-ferrous metals, precious metals. I took over the precious metals book in January of 79, having been writing about oil and gas and electric vehicles and a variety of other things prior to that in 1978. The price rose sharply up to about $400 in the third quarter of 79, traded sideways, and then in December rose very sharply from around $400 to an intraday spike of $850 an ounce. A lot of people don't realize that the day after that spike was the day of the biggest gold price move in history until 2013. It was a downward move. The gold price fell something like $146 the day after it touched $850. It closed that day below $600. It's a little bit skewed here on this chart. So you saw a very sharp increase in price, below off peak, some people would say, and then a decline. And the price continued to decline over the course of the rest of 1980. That was January of 1980. It ended the year around $600. That occurred in the late stages of an economic expansion on the throes of a recession at a time when inflation was 14%, not 3.2% or even 3.8%. 14% inflation, 21% interest rates. Paul Volcker saying we have to kill inflation, even if that means throwing the economy into a recession. And he did. Oil prices, meanwhile, we had U.S. hostages in Iran. We had Soviet troops in Afghanistan. We had oil prices rise fourfold. You had a very chaotic period of time, leading into what was then the worst recession since World War II and the Great Depression, superseded by the one in 2007, 2009. So it was the late stages of an economic expansion. People were wealthy. The stock market had done halfway decently, and they were very much concerned about how to preserve their wealth. It's very important to know that in 1979, 1980, options on commodities didn't exist. Options on stocks. There were individual stocks that had options, but they were not stock option futures. There were not stock index options or stock index futures. There were not currency options. There were very few ways for investors to protect themselves or hedge their portfolio going into economic crises, financial problems, or recessions. Gold and silver were the two easily, readily available ways to protect your wealth and hedge your wealth and your portfolio back then. Radically different now when there are all sorts of instruments that you can use if you're willing to take the counterparty risk involved in the global financial market. And a lot of those opportunities to hedge your portfolio now are traded on exchanges and cleared. And if you look at the COMEX and the CME, they've never defaulted on a contract because of the clearinghouse system behind them. So principal-to-principal contracts options have greater counterparty risk than exchange-traded options that have a clearinghouse behind them. Radically different time. The next period I want to look at is 1987-88. It occurred in the middle of an economic expansion. The gold price had bottomed out in 1985 around $280, $286 an ounce. It had started to rise. CPM Group actually was still part of Goldman Sachs then. We issued a buy recommendation on gold in March of 1986, saying the gold price is likely to rise. We actually had a target of around $500. The gold price moved up and it was trading between $450 and $470 for much of the middle part of 1987. there was a stock market decline which occurred in September and into October. And over the course of September and October, the stock market declined sharply and fell very sharply on what was called Black Monday in late October, when the stock market fell very sharply. And gold prices started to rise. They rose sharply there. You can see they got up to about $490, $495. They backed off a little bit in November and ultimately rose over $500 in December of 1987. They started to come off. At that point, we were in the middle of an economic expansion. Inflation had been coming down for about 5 or 6 years. And the Fed had a new chairman. Alan Greenspan had taken over earlier in the year. The Fed looked at what was going on in the stock market and said, stock prices are falling sharply because of stock market events, not because of economic problems. There were a lot of people who, when they saw the stock market fall, say, oh, this means we're headed into a recession. You were part of the school that said, the stock market has projected 14 of the last 2 recessions. And what was going on was a stock market phenomenon. The stock prices had gotten overvalued. The economic environment was good. And people were calling on the Fed to slash interest rates, but they didn't. They said, no, we don't need to slash interest rates. The economy is doing fine. Inflation's coming down. Economic growth is healthy. This is a stock market phenomenon. We're not going to lower interest rates. We happen to agree with them. Our view at the fourth quarter of 1987 was that there would be a recession, but it was probably 1990 or 1991 before it occurred. We had a list of factors that we said, and these factors are going to push gold prices down. And these are the factors that we're looking to see shift before we recommend that gold again. So in January of 1988, we issued a sell recommendation on gold. Price was around $480, $490 an ounce. And by March, it had gone down to about $430, $425. And it ultimately declined down to around $320, $340 an ounce between 1988 and 1992. So, middle of an economic expansion, stock market crisis drives investors into gold. Gold prices rise. People get bullish. They're talking about $850 gold again, right? And within 3 months, the price is off about 20%. Bad example of bullishness. In 1999, we were late in an economic expansion. The economy had been doing extremely well. We had a recession in 1991. It was very short and shallow. We were out of it by 1992, although no voter believed George H. Bush when he said that. We had a very strong economy from 1992 through 2001. We were late in that economic expansion. There was a stock market bubble that was brewing. There were people saying that the Dow Jones would be $40,000 by the turn of the century, $40,000 on an index basis by the turn of the century. And there were all kinds of bullishness. There was the internet tech stock boom, where you saw hundreds of shell companies raise billions of dollars, actually trillions of dollars. That burst in 2011 to the cost of something like $7 trillion in current dollar terms for investors who had believed that internet stocks were the cryptocurrency of the time. In late 1979, or late 1999, there was a liquidity crunch in the physical gold market, and it started to appear around June, July, August. And people saw that. And one investment bank that was a heavy gold trader at the time actually took delivery of gold in the August COMEX contract. And people were saying, why would they do that? And CPM Group's analysis, which we provided our clients, was the physical gold market's getting tight. There could be a liquidity squeeze. when the October contract comes due. And if there is a liquidity squeeze, people will be scrambling for physical gold. Now, this investment bank could easily have bought that amount of gold. It was about a quarter, if I recall correctly, about a quarter of the gold that was registered with the COMEX at the time. That investment bank could easily have bought that gold, if it wanted it, anonymously in the OTC market over the course of a week or two, and no one would have known that they had bought it. The fact that they bought it by taking delivery of August COMEX contracts, they were signaling to the market, hey, if you need gold in a few months, like going into the October COMEX delivery, we've got it. So you got into late September. There was a liquidity squeeze. People were scrambling to cover their shorts in the October contract. We said if this gets over $270, $273, the price could go parabolic. We had a 3 standard deviation move upward in the gold price, followed by a 5 standard deviation, followed by a 13-point standard deviation change. The gold price went from $255 to $270, broke that level, and you saw the price go up to $340 on an intraday basis as companies that had short positions in the OTC and the COMEX and elsewhere were delta hedging that. They weren't necessarily getting rid of their shorts. They were buying futures and options and forwards to hedge their short position. If you got rid of your short position, you capitalized your loss. If you hedged it and the price came back off, you would minimize your loss or obviate it entirely. So there was not a lot of short covering going into that, the short sales going into that. It was short covering, it was hedging, it was delta hedging. And of course, at the time, a lot of people had no idea what they were talking about when they were saying, oh, it's delta hedging. And they thought that there was some sort of physical metal involved. This was a credit issue. Price got up to $340 after about 5 trading days. And then by December, it was back to around $275. Still marked the market higher than it had been before the liquidity squeeze, but that move to $340 was not the beginning of an upward move to $850. It was just another period of time. I should say, within a year of this chart, in early December 2000, CPM Group issued another gold buy recommendation. We had issued a buy recommendation in 93, a sell recommendation at some point between 93 and 2000, and in, I think it was in 1997. And then in 2000, December of 2000, we issued a gold buy recommendation, which we kept in place until the end of 2011, the beginning of 2012. But you saw the gold price come off back to those sub $300 levels within a couple weeks. That's the important part for sure, for the people worried about the what comes next. 2008 was the first leg of an upward price move that took place during a deep recession and a global financial crisis. And it was the early stages of the global financial crisis. Bear Stearns went bust the day that gold broke over $1,000. We told our clients, stop buying gold at 1,000 plus. Buy puts. We were saying buy August puts with $900 strike price, because we think that between now and July, you'll see the gold price come back down to around $900. You can sell those puts back at a profit, and then you can probably start resuming buying physical gold, because this looks like the beginning of a bigger upward move in gold. We were wrong. The price of gold got down to $900 within like a week of breaking over $1,000. By the end of that week, I think it was like $906. So the price came off. It moved sideways, basically between $850 and $950 for several months. But then in September and October, when the next leg of the financial crisis happened, and Lehman Brothers went bust, and you had other banks being and brokerage houses being sold off to various people, and fire sales to assume the liabilities, the gold price rose again. So the gold price, as I said in the very beginning, the gold price spiked in March of 2008, and the next spike was September of 2008. 2011, we were now in the late stages of that global financial crisis and the early stage of expansion. The recession had ended in 2009, but we had sovereign debt issues around the world. We had what they were calling the pigs. It was Portugal, Ireland, Italy, Greece, and Spain having sovereign debt issues, similar to what Eastern Europe and Latin America had in 1980, 81, 82. You had the downgrading of the U.S. Treasury's credit rating in, I believe, July or August of 2011. Gold price rose. It had been trading higher. It was trading $1,300 to $1,500, trading around $1,500 in the second quarter. It spiked up to $1,900 on an intraday basis. It settled just below $1,900, and then within a couple weeks, it was back down to $1,600. CPM Group issued a sell recommendation. The first trading day of January, we said a time to sell. And the silver and the gold price declined basically from September of 2011 into 2013 when we issued another buy recommendation. So going back, this is the rhythm of markets. And gold is a market. This is the rhythm of market. You find similar ebbs and flows, ups and downs across markets. If you don't, then you have to worry about a market being manipulated. But if you see this ebb and flow, that's a sign that it is not a manipulated market. And gold is a market. Don't believe that it's different. It has different characteristics, but at the end of the day, it is a market. So that's what we've got. Not saying that the gold price is going to fall sharply. We're not saying that the gold price has peaked and is now going to enter a cyclical downward trend. Our expectation is that the gold price will rise, that it could come off in the next few weeks and months, and it could consolidate in the second and third quarters. But then we expect to see the gold price rise and rise to new highs later this year into next year, and then come off. You may go to our website and find all kinds of free reads and videos and reports that we've written. You may order our gold yearbook, which we released 2 weeks ago. You may pre-order our silver yearbook, which will come out in May, and will provide 200 plus pages worth of really good, unbiased data and analysis on silver. Our platinum yearbook for 2024 will come out in the middle of July. You may send us an email at info@cpmgroup.com saying, you guys seem to know what's going on in these markets. This is my position in the market. This is my price exposure. How do I protect my wealth, and how do I enhance it through capital appreciation through exposure to commodities, not just precious metals, but we also do base metals and specialty metals and commodities in general. That's all I have for now. It's a long video. Have a good weekend. We'll talk to you next week. Try to be good to yourself. Try to be good to those around you. And see what you can do to help the world.